Hello everyone, and welcome to Proactive Investing. Over the last year, the share market has been quite volatile, with growth stocks experiencing a crash at the beginning of the year, recovering, and then supposedly experiencing another crash later on. So, today's video is about the top 5 stocks you absolutely do not want to miss out on in 2023. Also, check out other videos on this channel. Before starting the video, let's have a clear idea about what stocks are. A stock, also referred to as equity, is a type of security that denotes ownership in a portion of the issuing company. Shares, also known as unit of stocks, entitle its owners to a share of the company's assets and income in proportion to the number of shares they possess. Most individual investors' portfolios are built on stocks, which are mostly bought and sold on stock exchanges. Government standards designed to shield investors from dishonest tactics must be followed during stocks trades. In order to raise money to run their operation, corporations issue stock, and the holder of that share, known as the shareholder, may be entitled to some of the company's assets and earnings. Based on the proportion of shares an investor owns to the total number of outstanding shares, a shareholder is regarded as an owner of the issuing firm. If a corporation has 1,000 outstanding shares of stock, and one shareholder had 100 of those shares, that shareholder would possess and be entitled to 10% of the company's assets and profits. Corporations are a unique sort of organization, even if stockholders do not own them, since they are regarded as by the law as legal persons. Companies report their taxes, can be sued, can borrow money, and can possess property. A company owns its asset if it's thought of as a person according to this concept. The corporation, not the stockholders, is the rightful owner of a corporate office filled with desks and chairs. Investors will certainly remember this year as one of the most difficult in history when they reached the proverbial finish line for 2020 in less than 2.5 months. All 3 of the widely followed Dow Jones Industrial Average, the benchmark S&P 500, and the growth stock-focused NASDAQ Composite have entered a bear market, with their peaks seeing declines of between 22% and 38%. Significant market declines can be emotionally taxing for many people and test their commitment to keep investing. However, history shows that investing during bear markets drops is a wise choice. Every notable downturn in a bear market in history has ultimately been forced to eat its own tail after a bull market rebound. Because of this, 2023 may be a new beginning for long-term investors, which makes it even more compelling to go shopping. The next 5 top stocks have the catalyst and other qualities necessary to increase your wealth in 2023. They are as follows. 1. Meta Platforms. The number 1 media stock in the world, Meta Platforms, Meta 6.46%, comes first. Despite having a terrible year, it seems that worries about Meta's expenditures on the metaverse and ad income are exaggerated, which positions the business well for a strong rebound in 2023. 4 of the most popular social media sites on the planet are parents of Meta: Facebook, Instagram, WhatsApp, and Facebook Messenger. 3.65 billion individuals visited at least one of these websites each month in the quarter that ended in June. That amounts to more than half of all adults on the planet. The number of monthly active users on Meta has risen despite a challenging domestic and global economic climate. Advertisers are well aware that Meta-owned assets are the only platform on Earth that allows them a better opportunity to communicate with audiences. The $40.5 billion in cash equivalents, and marketable securities on Meta's balance sheet, as well as the $58.5 billion in operating cash flow it generated over the trailing 12-month TTM period, gives Meta the freedom to spend impulsively on the metaverse, which is another thing to take into account. With the potential to be a multi-trillion-dollar opportunity, Meta wants to establish itself as a major entrance. This business is extremely profitable and can easily afford to invest in high-growth initiatives. 2. Enterprise Products Partners. Enterprise Products Partners, EPD 1.31%, an oil and gas firm, is the second best stock that you can buy to increase your wealth in the future year. Enterprise has increased its yearly basic payout for 24 years running, paying shareholders a whopping dividend of 7.5%. As rumors of a U.S. recession circulate, some of you might be hesitant to invest in oil equities, but Enterprise Product Partners might allay these worries. It is a midstream operator, which explains why. It is in charge of 20 gas processing plants, 14 billion cubic feet of natural gas storage, and more than 50,000 miles of transmission pipeline. No matter how volatile oil and natural gas spot prices are, midstream operators rely on fixed fee or volume-based contracts, which makes their operating cash flow very predictable. Furthermore, the global energy complex is inoperable, or at best compromised. The recession drastically decreased capital investments, and Russia's invasion of Ukraine has jeopardized the oil and gas supply to areas of Europe. Energy commodity prices should stay above average if there is no immediate global supply fix. Domestic drilling is anticipated to increase as a result, which is advantageous for midstream companies like Enterprise Products Partners. 3. MasterCard. Another rock-solid stock that has a decent possibility of making investors wealthy in 2023 is the payment processor MasterCard, MA 1.72%. A barrier for the majority of businesses is historically high inflation. However, inflation might work in a corporation's favor if that company is MasterCard, whose revenue is derived from fees associated with payments made using credit cards. Consumers will continue to purchase goods and services that are essential necessities regardless of inflation. Additionally, increasing pricing may cause customers to use credit cards more frequently in the near future. A second factor supporting the notion that shares would rise in 2023 following a challenging 2022 is MasterCard's prudent financial management. The company's management team has exclusively focused on payment processing, even though it would probably be a profitable lender. MasterCard doesn't have to worry about setting aside money to cover loan losses because it has decided not to lend. The fact that MasterCard doesn't require just-in-case money to cover loan losses is a major factor in why its profit margin is set firmly over 40%. 4. Berkshire Hathaway. Although he's not perfect, billionaire Warren Buffett has been the CEO of the company Berkshire Hathaway for a considerable amount of time. BRK.A 1%, BRK.B 0.67%. Buffett has supervised a 20.1% annual average return for his company's Class A shares over his 57 years as CEO, BRK.A. With such a track record, Berkshire is unquestionably a desirable investment for 2023. The success of the Oracle of Omaha is largely due to two important components of Berkshire's investment portfolio. First off, it's stacked with cyclical equities or companies whose fortunes fluctuate according to how well the American economy is doing. Although recessions are unavoidable, Buffett is intelligent enough to realize that expansionary periods typically endure much longer. He has Berkshire Hathaway set up to profit from those protracted bull markets. Buffett's enthusiasm for dividend-paying stocks is the second positive element for Berkshire Hathaway. Buffett's company could earn more than $6 billion in dividend income during the upcoming 12 months, almost usually profitable in tried-and-true dividend stocks. For patient investors, they are a wise hold because they have a history of outperforming businesses that don't pay dividends significantly. 5. NextEra Energy. NextEra Energy, NEE 3.52%, an electric utility stock, is the fifth top stock and has all the ingredients for you to become richer in 2023. In 19 of the last 20 years, NextEra has given its stockholders a positive total return, including dividends paid. The reliability of their operational model is the best thing about utility stocks. Customers of NextEra Energy don't significantly alter their patterns of electricity consumption from one year to the next. It is crucial for a company to be able to predict its annual cash flow properly, since doing so enables it to invest in new initiatives, acquisitions, and dividend payments without jeopardizing its profitability. The fact that NextEra Energy is focused on green energy projects, however, tends to set it apart from other electric utility stocks. No electric utility in the nation is able to produce more power from solar and wind sources. The cost reductions of relying on renewable energy especially stand out for NextEra, given the high price of oil and natural gas. While most utilities have a modest growth rate, NextEra's emphasis on green energy should enable it to maintain a high single-digit earnings growth rate. So, these are my top 5 stocks to buy for 2023. Which ones are you interested in? Let me know in the comments below. Don't forget to like this video if you enjoyed it. And remember, in order to invest in your future, you need to invest in yourself. Good luck with your stock investing in 2023, and I'll see you in the next video.